With the September Fed meeting behind us, our next guest says many of the bearish drivers for gold appear to have shifted, which could be gold positive. Joining us today is Mike McGlone of ETF Securities. Mike, thanks so much for being with us.
Thanks for having me back.
So let's talk about the Fed decision. I'm thinking you weren't surprised, and what's next?
No, it's what we talked about before. The trend in Fed tightening expectation is either reduce or delay. And one thing we have to remember is we have to be beware of consensus expectations.
Right.
So the foundation for this was really what happened at the beginning of 2014. Remember in the beginning of the year, 2014, everybody expected bond yields to go up and commodities to go up. The opposite has happened, and they continue to trend down, which means deflationary trends. And the Fed basically just pointed out the obvious, which most of us see in the market. And I think the key thing is they have to think about what are the repercussions of their decisions when you look into the future. If they tighten now, and what happened in August continues, stock market going down, volatility picking up, the market will blame them. Not rightly so, but they can't take that risk.
Well, why do you think the Fed has been so focused on tightening? Is it the excessive risk-taking that we've seen in the U.S. stock market? Is that playing a role?
Yes, and you probably can see that in that chart on this screen. Right. They have said so. So on the chart on the left-hand scale it's a chart of the S&P 500 in logarithmic scale, so we can compare apples to apples with Fed funds. And the market's just taken off. Why? Well, the Fed was printing money, QE, so they probably overstayed that welcome in QE. But if you look at this trend, this is a discussion we had a little while ago.
Right.
Well, the market goes down. It went down from 2000 to 2002 from basically 1,500 to 800. And the Fed reduced rates from 6.5% to 1%. So it goes back up again. It goes from 1,500 back down to 700. And they reduced rates from 5.25 to 0, where they are now. Now we've tripled in value. So the market's way over excessive versus Fed funds, and that's one thing I know the Fed's got to be worried about is this potential, we could call it mean reversion, implosion. That's the risk they have to be concerned about.
Well, let's take a look at gold now, Mike. Right after the news, the metal got a boost, even though this Monday it is seeing a corrective pullback here. But you say a lot of the bearish factors for gold have maybe disappeared?
Yes, well, let's look at the primary asset class that we just mentioned. Gold is basically the quintessential alternative asset class diversifier for portfolios. There's nothing more liquid and quick you can get in and out of, and certainly ETFs. And the equity market's a primary asset class. Now, it's had that massive run. It took all the attention away from gold, and it looks like it's finally stopping or reverting. So to me, that's a key reason. In addition, Fed tightening expectations. Way out into the future, all these tightening expectations. In this environment of global deflation, that's been a major pressure factor on gold. It's, it's made the dollar stronger. And a lot of these things are changing. In addition, a key thing is the primary commodity in the world is crude oil. Crude oil has collapsed over the last year, and it met a good support level right around the 2008 low, which was around 35. It's not going to go much below that in any time soon.
All right. Well, you brought us another interesting chart that looks specifically at the stock market. You point out that based on historical data, looking back to 2011, gold may be set up here for further gains.
Yes, I call it kind of the transposition risk era. It sounds complicated, but let's simplify this. This chart is chart of the S&P 500 going up and the inversion of gold going down. But if you put the inverse, you can see it going up. And back in 2004, when gold topped around 1,900, the S&P 500 bottomed around 1,200. Basically, here we are 4 years later, those prices have basically transposed. Gold is around 1,200, a little bit below. The S&P 500 is around 1,900. To me, the risk is that the S&P 500 continues to go down, and they both meet maybe around 1,600.
Okay. Good news for gold then.
It could be, so that's why one of the key things for gold might be, unfortunately, to watch the stock market. And that's why one of these things I've been saying about being bullish gold, I'm okay being potentially wrong on that if it means that the primary asset class continues to rally.
Okay, just quickly, what time frame would that be in? I always ask you time.
I know time, but as an analyst, it's one thing you always got to be careful of putting time on it. So I want to be a little careful with that, if you don't mind. Sorry.
All right, Mike. Thanks so much for joining us today.
Thanks for having me.
And thanks for watching this edition of Kitco's Gold Report. We'll see you tomorrow.